Thank you for being here for the Freedom Reserve System. How are you going to manage your banking system? This is one of the coolest segments for you to see. How do you make money flow through your personal economic money model and really make your money work for you? So we've got two accounts on the screen. We've got the Freedom Creation account. We've got the Freedom Reserve Bank. Let's make the assumption that you've been funding your Freedom Reserve Bank for several years. You've got $100,000 in your Freedom Reserve Bank. It's there, it's safe, it's private, it's been tax sheltered, it's been accessible to you. But I'm going to go all the way out to, you've got $100,000 in this Freedom Reserve Bank. You want to access $50,000 for something in your business. This is how it works. You take a loan from the insurance company. You fill out one piece of paper by signing the bottom and putting in the amount. Say, send me $50,000. This is the easiest way you'll ever access money. Any other loan, and think about this, you've already went and got some loans, right? Any of you already bought a house? You ever seen the 3-inch thick stack of paper that you got to sign, right? Well, we got a one paper, you sign it, and the insurance company looks in your account. If the amount of the loan you're applying for is less than the amount you have in your account, the answer is yes, and they send you your money. Generally, you're going to get your money in 5 business days. Somewhere between 5 and 10 days, you'll have a check sent to you from the insurance company. The insurance company does not send you your money. The screen shows that you're getting continuous compounding on the entire amount that's in your Freedom Reserve Bank tank. So that $100,000 is still earning you money at a 4% return over the time that it just sits and grows consistently. So you get continuous compounding, but you take a loan called a collateralized loan from the insurance company. They send you a check. You deposit that check into your Freedom Creation account. That's an account that you personally own. Now you make an agreement with your business that your business should use this money for constructive purposes, hopefully to make you some more money. So you do a loan with your business and you write 2 instruments. You use a promissory note and an amortized schedule. The promissory note is simple. It's basically a 4 or 5 sentence document that says my company ABC agrees to pay you back at this amount, this rate, this term, and your business agrees to it. So it's that easy. That's what a promissory note is. It's a promise to pay. So you set the terms in maybe a 4 or 5 sentence document, and it would be good to have this notarized so that you have a paper trail that you can show to your CPA or anybody that would ask for your loan documents. The amortized schedule, also simple. You can go to our website. You can do this through many ways, but an amortized schedule, you should print that out as to what the business agrees to pay you back for the use of your money. Now, do you think that your business should be able to pay you back at a low rate of interest, or should your business have to pay you a high rate of interest? What do you think? A lot of people get stumped on this, and they actually think the business should pay them a low rate of interest because it's your business, and why would you want to charge your business a lot of interest? It's the opposite than what you think. You should actually charge your business for the use of your money. Now think of this. You should charge your business a retail rate of interest because your business is going to take a tax deduction for the interest that it's paying you. So create a tax deduction. We always suggest that you use a rate like 10%. By the way, have you ever heard of anybody in business lending money at 12% or borrowing money at even credit card rates of 28, 29, 31%? Have you ever heard of anybody going to hard money lending to get money? So folks, 10% is a good retail rate. You don't need to be a hog at the trough. You don't need to charge 30%, but 10% is a good rate. So if you charge 10%, your business takes a 10% deduction. Now, the business is going to send you that interest. Now, you have to claim that as your income, but you're not claiming it as wages. You're not paying the Social Security wages on this. This is passive income, and it comes better than what wages would come to you. So it's another way that you can have money come to you and make money. It's much like if you own a property and a property pays you rent, it works the same way. So once money goes into your personal freedom creation account, you've got a 10%. If the story stopped here, this is where many of the CPAs of the world will say, well, you didn't gain anything. You lent your business money, it took a 10% deduction, you took a 10% gain, it's a wash. Fortunately, they don't know the rest of the story, but you do. So how this works is this. You've got to claim the 10%. Now remember, the insurance company, they charged you for the use of their money. They did not send you your money, they sent you theirs. And to further solidify this thought, if you took a loan from the insurance company and you died while it was still borrowed, the insurance company would have subtracted their money they sent you off of your death benefit. So they never sent you your money, they sent you theirs. Make sense? Perfect. At the end of a year, you pay the insurance company for the use of their money. Now, if you have a properly structured permanent life insurance program, you're going to be able to borrow money very inexpensively. A lot of the companies we work with charge like 5%. So when you pay the 5% loan back to them, it's deductible interest to you. And once you pay that loan back or a portion of the loan back and the interest, what it does is it decreases your loan and it creates increased collateral capacity. You see, the more of the light green here that you have, when you've put the money back into your Freedom Reserve Bank, the money now becomes available for the second project, for the third project, for the fourth. And as many times as you can see that you can use this dollar over and over and over and over, you not only get compound interest inside of your tax shelter, but you get compound use of the same dollar. This is called the velocity of money. Truly, when you understand this concept, you'll understand that you had to claim the 10% for yourself because you made money on your money. Isn't that a cool concept? You made money. But when you paid the insurance company 5%, that left you a net gain of 5%, right? The whole time you did this, all of the money that's in your Freedom Reserve Bank continued to earn 4%. Uninterrupted continuous compounding. That means you've made 9% on your money just by learning how to use your money. I want to take you one step further. If you would have used the traditional banking system and you'd have paid somebody 7, 8, 9, 10% and you'd have paid that away to another bank, how much did you earn on that? You didn't earn anything, did you? Every dollar you spent in interest and fees and time and the work you did to try to qualify for that loan, that is not just gone, it's gone forever. And when you've already learned about lost opportunity cost, the money that you spent away on that interest isn't just the dollars you lost. It's the dollars that you could have recaptured had you learned how to have this money come back to you multiple times in your life. Folks, it is limitless what you can do once you learn how to be a Freedom Reserve banker. Thanks for listening. I'd like to see you as happy as this smiling couple. The Freedom Reserve system truly is about connecting life and money. Thank you.